My name's Eric Abady. I'm a partner with ATKG. ATKG and Capital Farm Credit are putting this on for you tonight. When we go through our busy seasons and through our course of our year, we look for opportunities to share information with our clients and our business affiliates that we think would be very pertinent and useful to you. So this year we identified some topics on ranches and how that will impact you this year. So we've put together a great slate of speakers, and we're looking forward to hearing from all of them. And there'll be lots of great information shared with you tonight. I'm going to call up our first speaker, Susan Graham of Graham Tax Solutions. She's going to talk to us about IRS's perspective on ranch tax issues.
They asked me to speak today. I've worked with Melanie and Carrie mostly at ATKG, and I've worked with, I hope I haven't seen any of you in the adverse relationship. The reason they asked me to speak is I worked for IRS for 31 years. I went to work there planning to stay 2 years, and life happened, and I ended up 31 years later retiring. I've been on my own for 5 years, and I'm an enrolled agent, and what that means is the Internal Revenue Service has licensed me to practice before them and represent people before them. And since all of the people in San Antonio used to work for me, it's been kind of handy that I have changed the sides of the table. Unfortunately, they have hired a few new ones, but so far so good. And not too many of them are too unhappy with me. I have a degree in accounting from East Texas State University that's now a Texas A&M affiliate. So if I'm talking to folks from Texas, I went to East Texas State, and if I'm talking to people from A&M, I went to A&M. So I hope to keep everybody happy with that. I did grow up on a farm in North Texas. Greenville, Texas is my home, and my dad farmed about 400 acres of cotton primarily, and he raised cattle for our own consumption and to fill those money holes in the winter when we weren't growing something that we could sell. And we raised hogs, did all of that. So if anybody needs help driving a tractor, I can do it. So my dad was the original equal opportunity employer. My 3 brothers got bigger jobs. I was big enough to take the job. I got the job. So I know how to milk the cows and everything else. That's worked very well for my career with IRS, because when I went to work for IRS, I was 24 years old in Houston, Texas. And the first farm audit I did, my manager said, "Does anybody know anything about farms?" And I kind of raised my hand, and he said, "Okay." And he didn't really believe me. But he said, "Okay." And so it gave me an audit in El Campo, Texas, which is southwest from Houston. So I called up the CPA. And the CPA did everything wrong, in my opinion, about how to work with IRS, because he started off saying, basically, you can't do that. And of course, when you tell IRS that, they tend to respond in a similar manner. So he told me I couldn't see the farm. He told me I couldn't meet the farmer, and I couldn't do anything but come to his office. And back then, IRS was actually had a little more power than they do today. And I said, "Oh, yes, I can." And so I did. Well, we met in the CPA's office, and I asked questions like, where is your bank account, and how many children do you have, and where do what kind of business do you have going on, and so forth. And I said, now I want to see the ranch and the farm. It was really just a farm. And he said, "Oh, that's a total waste of time. You're just here on a boondoggle. You don't know what you're doing." Just really was giving me a hard time. And I said, "I want to see the farm." And so the farmer and his wife said, "Well, we'll show her the farm." And the CPA said, "All right, go, but I'm not going to waste my time." Big mistake. Big mistake. We go get in the farmer's truck, and we head out to the farm. And my first question, I remember it like it was yesterday, was, so do you grow short staple or long staple cotton here? And what have you got in the silo over here? And where's that piece of equipment on your tax return? And it didn't say anything about cattle on your tax return. And look at those little oil pumps going out there. I didn't see that on your tax return. And that guy rued the day, let me tell you. And, as an IRS person, I was doing my job. And the CPA was not doing his job. He should never have let me get that rancher farmer alone. And as my biggest piece of advice to you, I'll say it first and I'll say it last, is if IRS calls you, and which they're likely to do, as the supervisor of all the people here, I constantly said, forget sending a letter. Call them, go see them, call them. They don't have to send you a letter as the first contact. And if you can get somebody on the phone that's proud of what they do, which most farmers and ranchers are, and you say, well, why don't you tell me a little bit about your business? You will tell something you shouldn't have told before the phone is ever put back down. So my first and last piece of advice is, IRS calls you, you say, call my representative at ATKG. Call anybody but me. So you don't, I can't, I didn't feel bad about what I ended up doing to that poor farmer. And I heard the CPA on the phone calling another CPA saying, you better look out for this Susan Graham woman, she's their farm ringer. So it was ugly because there was a significant amount of unreported income and unreported expenses too, as it turned out, because the CPA had never been to the farm and really didn't have any idea what they did for a living. The big thing you have to worry about if you are a gentleman or gentlewoman farmer, in other words, it's not your number one source of income, is whether it is a business or not. Now, I'm sure Melanie or others are going to talk a little bit more about this, but if farming is not your primary source of income, farming and ranching is not your primary source of income, it's a whole nother issue. So if you make your living based on the weather and the bugs and the health of your animals, then this is not for you. But if you make your living doing something else and you have a ranch or a farm on the side, then you need to worry about some of these questions that I put up here. Is it your primary source of income? In my father's case, it was our only source of income. My father sold cotton, he raised wheat, he raised corn. Primarily he used it for feed for the cattle, but as a little girl, I used to remember that my mother and my father would cover the dining table up with paper about 1 week every year, and then they would fight back and forth. And I was very young as I remember this. My father unfortunately passed away when I was 15, so I had been a kid. And they would fight, and then my mother would cry. And I never knew what was going on, really, except you didn't want to go in the dining room that week. Well, come to find out, my mother told me later, after I'd taken a job with Internal Revenue Service, that was the week they did the tax return. And it seems that my father regularly did the tax return correctly the first time, and then he would decide he sold less bales of cotton or less cattle or whatever until he got it down to what he thought it ought to be. So I know that the day I went to work for IRS, my father was spinning somewhere, as were several of my brothers. Anyway, that's off the point. If it's your livelihood, great. However, I audited somebody one day. Actually, I supervised the audit of a giant ranch. They had thousands and thousands of acres in Texas. They had acres in Colorado. They had acres in, some in Arizona, wasn't very profitable, but they had a huge ranching activity. And we went forward at IRS with it as a hobby loss. Their sales alone for 1 year's tax returns over $2 million. And you'd think when it's that big that it couldn't possibly be construed that it was a hobby instead of a business. Well, their salaries for that $2 million in gross profit, the salaries was $3 million. And what it really was, in my IRS opinion, was that the man who was behind it all, the money man that had it all, this was his fun. This was his hobby. He had other people running it. He had other people doing it. But he was losing big money, spending big money. It was not his main source of income. And he was, we went after him as a hobby. So it doesn't matter if you're really big or really small. One of the first things that's going to come into any IRS person's mind is this legitimate ranching activity? Especially if you have a loss. Well, anybody that really does much ranching and farming is going to have a loss most of the time, or at least pretty often, especially if you're dependent on weather, prices, commodity prices, everything else. And, because of the equipment depreciation and so forth, it may not be an economic loss, but it might be a tax loss. So that's very important. How much time do you devote to your business? Assuming your farm and ranch is a business, you need to keep up with how much time you spend on it. In this particular audit of this big one that I was talking about, the man actually tried to convince me that he spent 3 hours getting ready for a phone call that took him an hour, and then it took him 2 more hours to decompress from the phone call. So he was trying to claim 6 hours a day on the ranching activity. We didn't buy it. Do you have a business plan for your activity? That's very important if it's not your major business. If it's a sideline business, it's very important whether you have a business plan. These questions come from the IRS. There are 9 factors in determining whether somebody has a hobby or a business. These are all part of those questions. If you hire somebody that has expertise, then that is in your favor. If you're audited, or especially if you're audited and IRS says it's a hobby and they deny your losses and you go to appeals, I can tell you for a fact that appeals will take the 9 factors and will say, IRS wins number 1, taxpayer wins number 2, IRS wins number 3, etc. And they will go through the list and they will write up their report that way. And at the end of the report, if they say IRS won 5 out of 9, you lose. These 9 factors, if you read what it says in the IRS publications, they say, oh, no one factor weighs more than another and it's not that big a deal and this is just a guideline, et cetera, et cetera. But I can't tell you how many IRS reports I have seen that came down to the end and said, well, the taxpayer only won 3 out of 9, so it has to be a hobby. So that's very important that if your business is a sideline business, it may be a business, but if it's not your primary business, you really need to go through that with your tax preparer. In one case, many years ago, before I went to work for IRS, I was going to college and I was working in a real estate business, and the man decided that he was going to become a rancher. Well, he was the kind of person who knew nothing about ranching. And this was in Rockwall, Texas, and he had bought a piece of land in Terrell, Texas. So if anybody in here has ever been in North Texas, I'm sure you think I might have a little bit of an accent, but the people from Terrell, Texas really have an accent. And he hired this ranch manager, and he bought a bunch of Simmental cattle, and this was in 1975 or so. Simmental cattle were the new thing. They were going to make everybody rich. It was almost a tax shelter. I know he paid like $40,000 for the bull that he bought, and he was buying half-breed Simmentals, three-quarter, you know, because they were just building the breed. Anyway, he didn't know anything about it. I grew up on a farm. He figures that out. He has me keeping all of his breeding records. He also ends up building a show barn so he can sell his cattle, and he dyes the sawdust green. You know, he's really impressive with his showmanship, but he doesn't know anything about cattle. So one day I said, how's the cattle business today? And he said, well, it's bad. He said, we've got a disease in our cattle. And I said, oh, you do? And he said, yeah, they got scars. And I said, all your cattle have scars? And he said, no, it's just the calves, but we got scars. And I said, I never heard of such a thing. I said, you know, we had a calf barn with no eyes one time. It was blind. We raised it on a nipple bucket and, you know, raised this cow, actually, you know, it was a heifer, raised her up. But I never heard of scars being a disease. And I finally said, would you write that down for me so I can look it up? Of course, we didn't have the internet back then. And so he wrote down S-C-O-U-R-S, scours. Those of you that have any cattle might know what scours is, but for the rest of you, it's basically diarrhea. So we had this disease. And I said, oh, okay, I got it now. Anyway, it was a disaster. His business partner was a businessman from Dallas. He was a real estate agent. They didn't know anything about cattle. They would have been prime for an IRS audit. As far as I know, they didn't have one. His only big move was he hired an expert to be his ranch manager. One of the 9 factors is, are you getting expert advice? Are you getting good advice? Do you have a business plan? We had a breeding plan. We had an expert that was actually tending the cattle, and, you know, he had a virtual expert keeping up with his breeding records, and it didn't really matter that he didn't know anything. He was basically just the money. So that's another 9 factors. Anyway, those are very important. If you were to get a call from IRS and you were told that they wanted to come audit you, I put this book together because, and it's double-sided printed, this would be what I would tell you to read first if you were going to try to represent yourself. And it's small print, too. The last 100 or so pages is the audit technique guide for farms and ranches that IRS publishes. They have an audit technique guide for many industries, but if you were to be audited, Chapter 8, for example, is on livestock marketing and auction barns. So you really are not, I don't care who you are, if you are the proprietor of a farm and ranch, you're not prepared to represent yourself. So that's my number 1 advice, is don't do that. I just had a new client came to me yesterday, referred to me by Elizabeth Copeland, and he said, you know, I did the tax return myself on TurboTax, and I went to and had an audit with an office auditor here, and he seemed like a real nice guy. And he said, we started out in 2010, and, you know, before you knew it, we were all the way through 12, and I didn't even know what was happening. And guess what? They denied everything they could find to deny, and they didn't allow what few things he did have in his favor. I worked an audit here in town with an office auditor, and the CPA who had done the tax return, it was a real estate agent, the CPA that had done the tax return had left some things off. And I called the CPA, and I said, why did you leave these items off? And he said, I thought her loss was big enough. And I said, well, it's always easier to come to the middle if you have a better place to start. I said, if you had put everything on there, then I could have come to the middle. But I basically audited her records, and I went into the audit with a bunch of adjustments in her favor. One of them was even a transposition error. And they had merely transposed numbers when they went from the books to the tax return. So it was clearly a mistake and in her favor. And the IRS person said, "We're not in the business of giving refunds. I'm not giving you anything in their favor." Well, she did know who she was talking to, but that was a big mistake on her part. And the client did end up getting a refund. But it was, if the client had gone by herself, she would have been toast. So my number one piece of advice when you're dealing with IRS is never handle it yourself, and never you should never be interviewed if at all possible. What I do when I represent somebody, they have a provision in the IRS handbook that if the representative can't answer the questions, they have a right to interview the person. Well, what I do is I do one heck of an interview on my person before I ever talk to the IRS. And then I should be able to answer every question. So again, if in the audit techniques guide, it tells the revenue agent what questions to ask. So for any of you that are with ATKG and you haven't done this in industry, there's about 20, 30 of these audit technique guides. If you ever represent somebody, you need to read the audit technique guide before you get ready for that audit. I don't care if you feel like a chicken. Don't feel like a hawk. IRS is not out there to play games. If you get to the point where you're getting an IRS audit, you have to remember that you're one of the elite, less than half of 1% that gets audited nationwide. So a computer has said you need auditing. A person has said you need auditing. A manager has said you need auditing. By the time a tax return gets to a person to do the audit, they are real sure that there's something on that tax return that's wrong. Because as territory manager over all those employees, I used to say, you must do a pre-audit analysis. You must figure out if there's going to be a return on the investment of your time and our expenses to put you out there to do that audit. So there's very, very few times when an IRS audit is done for information. There are times when they do that, but it's very seldom. So if they're coming for you, they think they've got a reason to come for you. And, do you get no changes sometimes? Yes, you do. I'll never forget, I audited somebody because on their other deductions, they had Christmas $50,000. And I said, all right, I'm going after Christmas $50,000. And of course, you're supposed to go ahead and pick out all those other things that look like they might be suspect. And then there's certain things that an IRS audit are mandatory. For example, if you have any kind of inventory, you got mandatory audit of the inventory. So I'm out there, but I'm out there primarily for Christmas. So in my initial interview, I said, what's this about Christmas on your $50,000? And you have to remember this was back in the 80s, so it's a lot more money than it is now. And they said, oh, we forgot to type bonuses. They would not have been audited if they had remembered to type bonuses. Fortunately for them, I was the kind of auditor that said, okay, I don't see anything else here that really needs to do it. I'm going back to the office. So I closed the case. But there's one guy in town, and I know Melanie and Carrie know who he is, and Elizabeth knows who he is. If he's your auditor, it doesn't matter what you say or what you do, he's going to be there for a year. And I'm sorry to say, I'm the one that hired him. I'm also sorry to say I promoted him. But I want you to take it easy on the management because it's really hard from your somewhat lofty position to know what the reality is out on your audit. And even looking at their work papers and so forth, it's very hard to know how bad he really is. But I've made quite a lot of money off of him now. So is I've helped Elizabeth with a case, and I've helped ATKG with a case, and I've helped another CPA firm in town with a case, and I've had one of my own. And he has done a horrible job, and he's really, really easy to beat in appeals. So I wish him all the best. But from your point of view, look out, because it's going to be miserable. So number one thing, what should you do when the IRS calls? Do not tell them anything other than who you want them to call and what their phone number is, or tell them, I'll have to get back to you. But don't chat. That's the worst thing you could do, is to chat. And then what you do when you get selected is, again, get somebody that's knowledgeable about not only you, but about representing you before IRS to help you with that audit. Thank you very much.
Our next speaker is going to talk about the passive activity loss rules, or passive activity losses, and that's going to be Melanie Kirk, partner with ATKG. So, Melanie?
Thank you. So now we're for sure not a hobby, and so the next thing we need to look at is our ranch a passive activity? So what are the passive activity losses? Well, Susan mentioned tax shelters. So back in the day, the 80s, right, there were all these tax shelters out there where you invested $10,000 and you deducted $100,000. Sounds great, right? Well, the IRS put in some rules in 1986 to start disallowing these type of losses from tax shelters. And they were called the passive activity loss rules. So what they did is they created basically 3 buckets of income. So you have your bucket of income that has your investments, so interest, dividends, royalties, capital gains. Your operating business, where you have your principal business, your wages, things like that, and then your bucket of passive activities. And so if your bucket of passive activities has a loss, those losses can't jump over to offset income out of the other buckets. So that's where we are with passive activities. And so why do you care? My ranch is not a tax shelter, right? It's not a jojoba farm or one of the other things that everybody invested in the 80s. Well, passive activity losses are not just for tax shelters. They apply to all businesses, and it's an hours-based test. And so after the hobby loss rules, so you've done a great job on that, the next line of attack by the IRS is the passive activity loss rules to try to disallow the losses from your ranch activities. So how do I know if my ranch is a passive activity? Well, like I said, it's hours-based test, and they want to see if you materially participate. And so there's hundreds of pages of regulations and rules on this test, but it's going to talk about basically the 2 tests that we usually use on our ranch clients. And the first one's really easy. Do you spend 500 hours a year working on your ranch? So that's a no-brainer to figure out how to do that one. And the next one is the substantially all test. So I have a ranch and I spend 200 hours a year, but that's all that it takes. There's nothing else to do, and so that would be, I do substantially all the work at the ranch. Well, kind of the trick here is what kind of hours will qualify under these tests. And easy, I go out to my ranch and I do labor out there. I cut cedar, I work with the cattle, I do that kind of stuff. Those hours definitely count. If you come to meet with your advisor on the ranch, you meet with Plateau here to talk about the ag exemption, you meet with any of your breeding record people, all those kind of tests are going to count under your hours test for this. So hiring a ranch manager, meeting with your ranch manager, all that counts. So what doesn't count? Well, none of our ranches are in San Antonio, right? They're out in the hill country. Commuting to your ranch is not going to count, so don't count the 2 or 3 hours it takes you to drive out there. And then there's kind of a test that we don't think about a lot, but if you have a ranch manager who runs your ranch and you basically oversee that person, but they make all the decisions, then you really need to watch out because some of your hours in management will not count. So when you think about what hours are count, some will definitely count and some are kind of iffy if you have a manager. So what do you need to do to make sure you don't lose these ranch tax deductions? Well, number one, keep track of the hours. So for most of our clients, the easiest test to do is to meet that 500-hour test, because ranches, not only are they a money pit, right? It takes a lot of time to do all the stuff out at your ranch. So every time you go out there, you're cutting cedar, you're doing anything, keep track of it and you say, what a pain, how am I going to do that? Outlook on your phone, on that calendar, just make a note on your calendar, I went out there and I spent 4 hours cutting cedar. I had a meeting with the cattle breeder and I talked about what breed of cattle I was going to work on. So keep track of all that on your calendar. And all right, so we haven't done that in the past. How many people did not keep track of their hours on their ranch last year? So that is not a killer, but my favorite quote from the couple of the cases is on here is that you can't use a post-event ballpark guesstimate. So that's an official term now in the hobby law, in the passive loss area. And so contemporaneous records are the best, but if you don't have them, you can go back to, for one thing, your calendar is a great thing to go back to, but then also your checkbook. What did you write checks for during that time period? And start going back and kind of supporting your hours. Because if you're looking at the hours for last year, wow, we're less than a year away. If you're looking at your hours 3 years from now, it's going to be a lot harder to remember. So really the best thing to do is to pick up your calendar starting in January of this year and start documenting it and keep track of it. So that is basically it.
Casey Morth is our next speaker. She's going to be talking to you about cost segregations and what that means in the context of ranches. So Casey, come on up.
So what is cost segregation? So basically, it's allocating the purchase price of the ranch among the various assets. So whenever you purchase a ranch, you may just think about the land, which is non-depreciable. You don't get any write-offs or deductions for purchasing land. But along with the land, you're generally buying the fencing, some roads, there may be a well, there may be some barns or buildings on the ranch. And so what we want to do, our goal is to have tax savings from the depreciation deductions that you get. So we want to allocate some of the costs to shorter life assets in order to get more depreciation deductions sooner. So that's our goal with cost segregation. And a cost segregation study can be done if you're just purchasing a ranch and you have the total purchase price, and we can do it then, or it can be done if you've already held the ranch and you purchased it a few years ago. You can do the cost segregation study and do a look back and catch up that depreciation until the current year. So either way, it's beneficial. So what can be depreciated? Any improvements that are used for business purposes. So if you buy a ranch and you are going to use the house for your personal enjoyment, but you're also going to run your cattle operation on the land, or you're going to have a hunting operation or something like that, anything that you use just for personal purposes cannot be depreciated, and you don't get any deductions for it. But any improvements that are used for the business can be depreciated. So if you have any buildings, those are generally depreciated over 20 years. And this may include barns or equipment sheds. If you have a ranch hand out there, his housing or her housing can be depreciated over 20 years. If you have land improvements, those are generally 15 years, and that may include roads, if you have culverts for drainage, if you have any dams or water lines or water wells out there that are servicing your operations for your business, those can be deducted over 15 years. And then our 7-year assets include qualified ag fencing or pens, as well as equipment such as deer blinds or deer feeders, water troughs, that sort of thing, tractors. Obviously, this list does not encompass all the assets that you could purchase on the ranch. You may have vehicles that you use on the ranch, and those can be written off over 5 years. You may have some animals that can be depreciated. Generally, for wildlife and such, the white-tailed deer can't be depreciated, but exotic game could be, and cattle have, everything has a different depreciable life. So come ask questions and see us if you have a question about that. So when do we recommend a cost segregation study? Well, number one, the ranch has to be used for a business purpose. That's the most important thing. And we say the ranch, it needs to be held long-term. And the reason for this is because we want to maximize the benefit of the study. So if you buy a ranch and you're planning to just flip it in a year or two, you won't get the benefit of the tax deductions from the depreciation on the cost segregation study. So if you're going to hold it longer term, you'll get more benefit from the study and be able to recoup those fees of the study. And then, of course, we want the depreciation deductions to be used by you, so we don't want you to fall into those passive activity loss rules that Melanie just mentioned. And so then I wanted to just walk through a quick example. Say you purchase a ranch for $2 million, and it's just a plain ranch, it doesn't have any buildings on it, and so you think there's not really that many assets out there, right? Well, say we go out there, so when we do a cost segregation study, we always like to do a site visit, so we visit the ranch, and we ride around with the ranch manager or the owner, and we take some pictures and measurements and look at surveys and appraisals. And so we go out there and we say, well, these land improvements, the fencing, roads, culverts, and wells, we decide that they have a value of $225,000. And then we find equipment that's depreciable over 7 years for water pump, the gates, the water troughs, and that has a value of $50,000. And then we allocate the rest of the purchase price to the land. So on this example, the depreciation in the first 5 years alone is almost $400,000. That's a $400,000 over those 5 years, a deduction that you get on your tax return. And if you're in the highest tax bracket, the 39.6% bracket now, that would be a tax savings to you of about $156,000. So a cost segregation study can be very, very beneficial. It's good news for taxpayers, and I will pass it on.
That has been an extremely useful tool for a lot of our clients. Everybody knows that ranches don't cost $2 million. They typically cost a lot more, and they don't come with no buildings. They come with lots of buildings and lots of improvements and lots of various different things on them. So very useful tool. We've saved our clients lots of money using those in conjunction with business plans and various other things that help us support non-hobby loss treatment. Our next speaker is going to be talking to us about sales tax. Annette Goodson, as manager in our office. Come on up, Annette. Thank you.
My objective is to give you guys a high-level overview of some sales tax issues with regards to farmers and ranchers. And I know a lot of you are probably thinking, wow, this is going to go really quick because farmers and ranchers are exempt from tax, aren't they? Well, that's actually a common misconception, and I think I actually had that discussion with somebody this evening already. Farmers and ranchers are not actually exempt entities. However, certain purchases that they make are exempt from sales tax. Basically, there are three categories of taxability for farmers and ranchers. There are certain purchases that are always exempt regardless of how you use them. There are certain purchases that are exempt only if you use them exclusively for agricultural purposes, and there are some purchases that are never exempt, regardless of if they are used on farms and ranches. So if we are growing crops and raising cattle and things like that, it's pretty obvious that we have an agricultural operation going on. However, there are certain activities that seem to be like they're kind of agricultural related. However, the IRS says, nope, these don't qualify for exemption under the agricultural rules. And so what activities are not exempt? Wildlife management and land conservation. Those purchases are not exempt under the agricultural rules. However, as we'll discuss in a minute, there are actually certain things that you can purchase tax-free if you are doing wildlife management activities. Maintenance and/or operation of hunting and fishing leases, horse racing, horse boarding, trail rides, commercial fishing, dog breeding and pet kennels, home gardening. All of those do not qualify for exemption. If I want to purchase something tax-free, what do I need to do? I need to obtain an agriculture and timber exemption and registration number issued by the comptroller. You can go on the comptroller website, fill out their form online and submit it, or you can print it out and fill it in by hand and mail it in. So once they issue that exemption number to you, whenever you want to make a tax-free purchase, you will have to issue an exemption certificate to the seller that includes your registration number on it. And basically, by giving that exemption certificate, you are certifying that you are purchasing those items for a tax-free use. Okay, so there are certain things that you can purchase tax-free, and you have to have the exemption certificate. Basically, fertilizers, fungicides, insecticides, machinery and equipment, including parts that are used in the production of agricultural products, and also if you're using them for building and maintaining roads or water supplies. Machinery and equipment used by an original producer for packing and processing ag products. Fencing, pens, and gates used to contain crops or livestock. However, general purpose fencing is not tax exempt. Components of an irrigation system that you're using to water your crops. Electricity can actually be tax exempt, but only if that particular electrical source is used exclusively for agricultural operations. You have to have it metered separately, and you can issue an exemption certificate to the provider, and they will not charge you sales tax on that. And you can go back and ask for a refund later if you find out that you've been paying tax on something that wasn't actually taxable. Services performed on any of the tangible property that I mentioned, the machinery and equipment, fences, pens, whatever. If you're having repairs made to any of these, the repairs are also going to be exempt. Certain off-road motor vehicles, if they're used in agricultural operations, and I'll get into that in a little more detail in just a minute. There are certain things that you can actually purchase that do not even require that you provide an exemption certificate. Horses, mules, and work animals. So if you're using horses to round up cattle, or if you're still doing farming the old-fashioned way and using mules to pull your plow, you can actually purchase those tax-free. Let's see, feed for farm and ranch animals and wildlife. This is one of those areas where I mentioned earlier that wildlife management is not considered to be an agricultural activity. However, if you purchase feed for wildlife and you're involved in wildlife management, you can actually purchase that feed tax-free. Seeds and plants that you grow where you're growing products for human or animal consumption are also tax-free. Certain items never qualify for exemption. If you're buying work clothing or home furnishings and housewares for your ranch hands or your ranch manager, can't buy those tax-free. Guns, ammo and traps, pet food, and certain taxable services such as real property repairs and remodeling, security services, and waste removal. Okay, so you're probably wondering about buildings and structures. Those can be some pretty large purchases. You don't want to pay tax on anything that you don't have to. So basically, if you have livestock barns, bunkhouses, machine shops, and things like that, those are not tax exempt, the materials for those. Repair and remodeling of non-residential real property are always taxable. So, and then also if you have a special purpose structure that it was built specifically for agricultural purposes, it cannot easily be adapted to be used for any other purpose, you can actually purchase that tax exempt. And I saw some examples on the comptroller website of like pullet houses and special milking barns and things like that. So if it couldn't be used for storage or for any other purposes, it's possible that you can purchase that tax exempt. Roads. Okay, so materials used to build the road are always going to be taxable. But labor to build the road is exempt, but only if you have a separated contract. If you have a contract that bills one price for labor and materials, the whole thing is going to be taxable. So you have an incentive. You may want to ask the contractor to break out that price between labor and materials. And labor to repair a road is taxable. So remember, labor to build it is exempt, but labor to repair it is going to be taxable. I get this question a lot on vehicles. Can vehicles be purchased tax-free? ATVs and off-road vehicles are generally subject to sales tax. However, they can be exempt from sales tax if they are used exclusively for agricultural purposes. And the key is that word exclusively. And if you happen to use them some for farming, technically, that is not used exclusively for agricultural purposes, and therefore it should be taxable. Motor vehicles designed for on-road use are not subject to the sales tax. However, they are subject to the motor vehicle tax. The motor vehicle tax is very similar to sales tax. In fact, most people think it's the same thing. But they are generally not exempt, even if they have the farm plates on them. And the parts to repair them are also not exempt. However, farm machines, trailers, semi-trailers, they gave us a little bit of break on that one. They said you only have to use them primarily, not exclusively, for farming and ranch use. And the statute and the comptroller rules don't define what primarily means. However, the comptroller generally takes the position that it has to be at least 80% agricultural use in order for those to be exempt. Last thing, the motor fuels tax. You can actually get refunds of the motor fuels tax, or in some cases on diesel fuel, be able to purchase that tax-free. If you are purchasing gasoline for engines and off-road motor vehicles that are used exclusively for agricultural purposes, you can get a refund of the tax paid on the gasoline tax. Diesel fuel is kind of a different case. Basically, clear diesel fuel, if it's used for equipment and off-highway equipment, generally it's not eligible for refund. But if you purchase dyed diesel fuel that's used exclusively for agricultural purposes, you can actually purchase that tax-free. You actually have to file an application with the comptroller to be able to purchase it tax-free. Once they send you your letter back saying that you're approved, whenever you go to purchase diesel fuel, you can give that to your supplier, and they should not charge you tax on that.
The thing to take away from sales tax is everything is taxed differently. So if there's a question, a doubt, a concern, call with a question. We will definitely get you an answer. It's a messy, very technical, it's just sales tax, but it's a pain, really is a pain. Next on our list today is Tim Milligan with Plateau. They have done a lot of services for ATKG clients in the past, and we thank you for coming, Tim.
We're on the property tax end of this, the wildlife management side, and basically our company has been in business for over 17 years now, and we help people make the transition. At least the backbone of our company is we help people make the transition from traditional ag to wildlife. So to give you an example of folks who might do it, a family like mine who had livestock all our lives, and things change and we decide we don't want to be in livestock anymore, but we can't lose that ag valuation, the lower property tax valuation. We can't lose that or we're going to lose the ranch. Or it was designed to help ranchers, the families that own the large tracts of land that for whatever reason can't be in agriculture production anymore. It's either bleeding them dry or the property is just not working out. It's just not working out for them anymore, to keep them from having to subdivide that property in order to hang on to any of it. So wildlife management came about for that purpose. But our company's been in business, well over 15 years. The founders helped establish the wildlife management valuation law. So I just thought I'd tell you a little bit about us so you know why I'm up here doing this. They helped establish the valuation law, had a lot to do with actually getting that law passed. What that really means is that we understand it, and we're one of the only companies that's dedicated to that purpose. Central Texas based. We have a staff of wildlife biologists. That is really what our company is all about. We have a staff of guys who are the core of our company that do the consulting for landowners. And then you have guys like me that kind of, my guys are kind of like my bird dogs and my kids. They make me look like I know what I'm doing. You know, I get to come out here and talk to you all about it and spread the word and try to help people understand it. The biologists do the work, and the people in the office make sure that it happens and happens correctly. We've helped over 2,500 landowners make that transition. We're probably getting close to 3,000 now. This past year, we did 350 wildlife management plans this past year. 230 of those were brand new wildlife management clients, people going from traditional ag to wildlife management, no longer managing and going through the livestock, but managing for wildlife. And you know, we're here, the company, Plateau, we have the ability to help in all different realms of it. There's some books here that have some information about us. We also have a law firm that's a sister company of ours, Braun and Gresham, that, you know, from a landowner standpoint and anyone else in the industry that needs that help, we do a lot with accountants, with attorneys, a lot of realtors and brokers and things that we work with who deal with landowners on a daily basis who have questions about this, and I like to think that we're just another tool in people's toolbox to try to help them get the right answers. We do have all the products and services and everything. Anything, if someone were to make the transition to wildlife, where we kind of stand apart is somebody makes that transition and goes from being traditional ag and moving into wildlife, we can help them through every part of it. We have technicians that will do the work for them. We have all the products and services and things that they might need to maintain it, and all the consulting that might be needed. So, why people choose wildlife management? A lot of different reasons, and there's hundreds of reasons, and I get them every day, but you know, a lot of times it's just they're tired of traditional ag. Either they can't handle it anymore, a change of lifestyle. Growing up, we didn't leave town much because we had livestock on the farm, and you know, like to remind people that those livestock, you know, it's different than having wildlife on your property. The wildlife can fend for themselves for the most part. If something happens and my water runs dry, the deer will go somewhere else and find water. I'm not responsible for them necessarily. If my water runs dry and the cows die, I'm going to feel pretty bad about that. And that's one of the reasons we moved out of it. No more grass, no more water. It's kind of hard to keep cows alive. It takes a little more than you want to put into it. They might want to improve the property, improve the value of the property, improve the look of the property. I was just commenting today, a landowner, I do a lot of work in Gillespie County on a nice ranch out there, and when I didn't think about this, it dawned on me, but we saw turkey there for the first time last year. And about 8 years ago, when I was on this property with the landowner, he mentioned that they see turkey out by the river all the time, and he was wondering why they're not on your property. I said, well, because there's nothing here that they want. It's full of cows, there's no cover, there's nothing, and short of moving the river over here, it's just not going to happen. Well, in the last 2 years, we pulled the cows off the back 600 acres, and I do a lot of quail hunts back there, and I convinced him to take the cows off and convinced him that the property we would generate more income, more revenue off hunting if it looked nice and if it was just a beautiful place to hunt. We were running out of habitat. Well, the habitat regrew, things came back in the last couple of years, and lo and behold, there's turkey back there now. And it dawned on me the other day, like, look, that's kind of what I preached to people, and it actually worked. You know, and I wasn't thinking about him because he's not in wildlife management. He's not one of our clients. It's just a place where I do a lot of quail hunts, and I got him to do what I wanted him to through that message. But resale value, limits of liability. You know, if you think about it, if you're in ag and you have livestock on your property, there are liabilities. Our place out on Garfield, the fence gets run through every once in a while. And when I was younger, the first words out of my dad's mouth would have been, "Where are my cows?" You know, they're right there on 71. So that's a liability that people don't think about sometimes beyond just the cost. Possibly less effort, and it's enjoyable. You know, it gives you some more freedom, and it's meant to be enjoyable. What wildlife management basically is just an alternative agricultural use. It's basically like telling the county, I'm going to run goats instead of cows. You're telling the county that you're going to manage for native Texas wildlife instead of managing the livestock that you're currently managing, or instead of crop farming or breeding horses or whatever it may be. It's just an alternative agricultural use. The property has to currently be in ag, so the people that qualify are your landowners who have a property that's currently in ag, and they're just interested in doing something different. They don't want to deal with the livestock anymore, or for whatever reason they need to move into ag. Or you have a new landowner. You know, there's landowners that come in that buy a property and maybe the fences are going down. They don't want to worry about rebuilding the fences. They don't want to worry about going into ag production. The tax valuation, the property tax valuation is the same as ag. Nothing changes there. And you're allowed to manage the property for native Texas wildlife. It's an activity-based program. You don't have to be good at it. You don't have to produce more wildlife. You don't have to make money doing it. You don't have to, if you're managing for songbirds or not, nobody's going to come out and check and make sure you have more songbirds. They are going to check and make sure you're doing certain activities that I'll talk about in a second. But there's 7 activity categories. You're required to do about 3 things a year. That's the requirement, is a minimum of 3 activities. We always recommend, as a company, we recommend people do more than the minimum 3. That you try to do 4, 5, 6, as many as you want to, as many as you can, reasonably, to where you're not overburdening yourself. We always try to make sure that you're well beyond. Just like, a landowner, what we've been talking about is dealing with the IRS, we deal with the county, with the appraisal districts, and maintaining that ag valuation. And you need to make sure you have good records. You need to make sure you're going above and beyond and going above the minimum. I have a landowner here in Bexar County who is probably one of the most valuable 10 or 15 acre pieces of property in Bexar County, and he could get away with putting 3 birdhouses out on his property as a supplemental shelter activity. It'd be crazy to put 3 birdhouses on that property and maintain an ag valuation by doing the very minimum. So he goes well beyond, spends quite a bit of money on his wildlife management, so he's putting up a good front, and he's actually showing that he's doing something substantial. And you'll find in a minute that a lot of the activities that are involved are things you're already doing if you're a landowner there, and if you're taking good care of the property, if you're hunting on the property, if you're running livestock, you're doing a lot of these things already. You're required to manage for native Texas wildlife, indigenous wildlife. I put this up here just because most people think of, and I get the question a lot, well, do I have to manage for white-tailed deer? It's not a deer program, and you don't have to manage for white-tailed deer. There's any number of different animals you can manage for. I have a lady in Fredericksburg, right outside of Fredericksburg, has 3 acres. She manages for songbirds and butterflies and maintains her ag valuation that way. It was a neat little property. She had 3 cows on it before we got to her, and it looked like this floor. It looked like a parking lot. It just had nothing on it. It was kind of a blank canvas. We were able to reseed the whole thing. It's a beautiful little property now. She has some plants that she's put in for butterflies and songbirds, and it's kind of fun. But you get to decide what you want to manage for. What's involved, the requirements. These are the 7 activity categories, and they're pretty simple, pretty basic. And it's things, habitat control might be cedar clearing or brush management of some kind. Managing prickly pear, killing prickly pear, cedar, mesquite control. We're doing a lot of mesquite control in our place in Garfield right now, so that's on my mind. Erosion control, people who have a piece of property that has any kind of water runoff problems, there's all kinds of erosion control activities that you can do, whether it's stacking brush and culverts or stacking rocks and stream beds and things like that to slow erosion. Predator control, if you're someone, if they have a property and you're hunting on the property, our landowners, we moved from ag to wildlife in the last year or 2, and the people who were renting the property from me happened to have killed a few hogs on the property, and that was a good predator control activity for me, and I was able to show that. Again, kind of harping back to what we were talking about, documentation and keeping records. When you do these things on a property, you make sure that you're keeping records of what you did, showing some pictures to the county, because they can ask you at the end of the year, what did you do? Just like being audited, they'll ask you for an annual report that says, what did you do? What were the activities you did this year? So a landowner needs to know and needs to keep a book of what they did. So at the end of the year, they can put it all together. Supplemental food may just be as simple as putting out a feeder. It could be putting in food plots. It goes back to, planting seeds. If you were looking for something that you could do that maybe, that was the sales tax exempt. If you're planting, the right kind of native grasses, planting seeds for wildlife, that kind of thing. Supplemental water this time of year, right now, water is such a big issue. And anytime you can put water on your property, you're going to get more wildlife. Supplemental shelter and census counts. There's these 7 activity categories. Shelter may be as simple as birdhouses, could be building brush piles. Census counts could be your own activities, going out to your ranch and keeping track of what you saw on the property for the year. Every time you're out there, maybe 3 times, 4 times a year, going to a certain piece of your property and keeping records of what walks by. Maybe putting cameras on feeders, that kind of thing, fun stuff like that can be enjoyable and can also be a wildlife management activity that you get to show the county what you did. And all this maintains your ag valuation. By doing those activities, you're given the same property tax valuation as someone who's running livestock or someone who's in traditional farming. And it's really it's a personal choice. And that's one of the reasons I like doing this, and one of the reasons Plateau does these presentations, and we run around and talk to people about this, and we deal with the appraisal districts and try to help them understand it. That's a big part of our program, is the education, trying to make sure the appraisal districts understand it, because it's amazing that it's been around for over 15 years. It started in 1995 was when the law was passed, And there's still counties that have no idea exactly how it works. There's appraisal districts that I'll walk in Mason County and Kimball County, and you'll go in there and there's 4 people and you'll get 7 or 8 different answers. How many acres do I have to have? What do I have to do? And no one fully understands it. And when I hear these folks talk about, you know, these tax issues and deductions and sales tax exemptions and things like that, I understand, you know, there's even more complicated issues out there. But one thing I always stress, we're not anti-ag. You know, we're not an anti-ag company. We're kind of more pro-wildlife, and I'm personally a little more pro-porch. You know, I want to be able to spend a little time on my property. I want to, you know, these are the things I like. This is why I did it. You know, I wanted to be able to spend a little more time. I grew up with my dad, you know, working cows, and that's what we did. But when the time came, you know, there are other priorities and other fine uses of my time. This is the kind of things I enjoy doing when I'm on the ranch. I want to see this. You know, I like to show off my bird dogs every once in a while. I want to see my property looking like that, not that. You know, and ours looked real close to that for a long period of time. And so did that property just before this. 2 years ago, it didn't look anything like that. And just taking some pressure off of it when it's not necessary to be in. And this is just for people who don't necessarily want to be in traditional ag. I'm not, you know, saying that there's nothing wrong with ag. Trust me, I've done it. I want to do more of this, you know, when I'm on the ranch, and less of this. You know, that picture right there reminds me so much of my dad. That's what we spent a lot of our time doing. And you know, while it's still kind of fond of my heart, I, you know, just prefer he didn't have to do it either. But you know, for me, the reasons keep going. This brings me joy. This not so much. So it's about how you want to use your property. You know, and then I'll close this, just leave up here some frequently asked questions. These are some of the things that come up when we're talking to people about wildlife management. Of course, we'll open this up to questions, but you know, the tax break's the same. Your taxes stay the same as they are now. So as far as, you know, if you're moving from ag to wildlife, there's no additional break. Part of your land can be in ag and part in wildlife. I have folks that want to keep cows. We still have cows on our place. You saw the picture of my daughter. We still have some livestock on our place, but we have it fenced off to where we can move them around, and that's actually part of our wildlife management activity. Those cows can be moved around strategically. They don't overgraze it like they used to. The place looks nice again, but we still have some cows. I still have a very productive coastal pasture that gets baled every year. The same guy's been baling it since I was a little kid. There's no reason to take that away from him, but I can keep part of the property in ag and part in wildlife, so you can do both. You can move back and forth. I have landowners here in San Antonio that just decided, hey, we want to be out of ag right now. We're not interested in it, but we might want to do it again in 10 years. We'll put it in wildlife, and then you can always transfer back. There's no, you know, you'll hear a lot about minimum acreage. There's no real minimum acreage as long as the property's in ag. And that's, again, one of those things that you need to, you know, if you're looking at moving a property into wildlife management and use, let's say it's a 10 acre or 15 acre property, something like that, anything below 20 acres, you probably want to have somebody help you with it, because you'll get if you call the county right now and ask them how many acres you have to have, they'll tell you 20, you know, which is not necessarily true, because if it's in ag, it doesn't have to be a certain acreage. But anyway, there's the requirements to get started. You know, there's things that people need to know. And why our company's here is that not enough people were able to do this. And that's why our founder started this company. It was kind of a complicated process. You're required to file applications. You have to have a wildlife management plan. It doesn't have to be done by a professional, but it helps. You know, whether it's us or somebody else, it helps the county know that you know what you're supposed to do, and it helps you know that you've got a good plan that's going to help you down the road to being successful, and you don't get into something that you don't really want to do. It all has to be done. The same tax filing deadline's April 30th. And, you know, Plateau, and there's other companies that are out there. Texas Parks and Wildlife. Texas Parks and Wildlife is available to people. They basically do what we do for free. But we're there for the landowners that need help. You know, that's come crunch time, that's where, you know, all throughout the year, someone who can't get the attention they might need from Texas Parks and Wildlife for whatever reason, they try to help everyone they can. But when they need help and they want personal attention, the average landowner with a couple 100 acres or 100 acres or whatever, 50 acres that needs that help, they can come to us for that. So that's my spiel. That's what I got. I appreciate y'all.
Brett Riff is going to talk to us about the current state of lending.
All right, so they asked me to give you a banker's viewpoint of the ranch lending climate. Well, the word banker is a little bit of a noble name, so I'm changing this real simply to my opinion, and y'all just have to suffer through it. The good thing with the viewpoint, you can't prove that I'm wrong, but I can prove that I'm right because I've got the mic. But real quickly, we'll kind of jump in here and give you a little bit of flavor of what we're starting to see. You know, there is some tightening in credit standards. Some of you might have leverage. Some of you, at one point of finance, most of you probably have been purchasing your assets with cash. but the lending market is changing a little bit. Whenever you dive back into that market, you'll probably find, if you haven't been in it for a while, that lenders are going to want to prove that you can service your debt. It's no longer just about the collateral. So we're seeing some tightening there. Most of that's a response to federal regulations, to a little bit of losses. But we, here in Texas, we very much appreciate strong land prices. We haven't had the rampant appreciation that we saw back in the early 2000s, but things are starting to tick up. Talking to brokers, talking to realtors, there's lots of activity out there. You guys are obviously seeing some strengthening in your balance sheets from your asset side. So we're sitting in a pretty good spot. All of that here locally is leading to a very robust lending environment. There's some strong banks. There's a lot of capital out there. There's a lot of money that's sitting still that needs to go to work. So if you're going to find some money, now's a good time to go shopping. The competition is strongest in our shorter term rates, not so much in the longer term rates. There's not a lot of lenders out there that are able to give you a really long-term fixed product, a 7-year product, a 10-year product, a 15-year fix. Those products are a little bit harder to find. But in the shorter term products, your variable rates, you get to name the game just about. A lot of this ties back to what's happening at the Fed. This low interest rate environment is exceptional right now. The FOMC, which is the Federal Open Market Committee, is holding Fed funds at a target rate of 0 to 0.25%. Banks are able to access funds from each other at 0%. That puts you in a pretty good position. But here's where the interest rate environment is now. This is somewhat of a barometer for where rates are sitting. I pulled this using the 10-year Treasury. This is a 2-year perspective. So if you're a new market entrant, you're at the far right side of this graph. And you're thinking, my gosh, I missed the low, my neighbor beat me, and rates are too high. But it's all about your perspective. Whenever you take a step back, looking at that same product, since 1962, you can see that we're still very much at the bottom. So my whole point here is you cannot go wrong. You might have missed the absolute low that we realized back in April 2012, but overall, as a borrower, you're going to come out well ahead of where you were just a few years back. I know many of you probably were accessing funds back in the early and mid-1980s. Look at that spike. What did that mortgage feel like? Fun stuff. So what does all this mean? Why the long face? Well, kind of like weather forecasters, economists, it's just a guessing game. But I'm going to kind of run through a few things here that we believe might be holding true. The first and foremost concern, I guess the main primary concern for you as a borrower, is inflation coming. Rates are at 0%. I'm a lender. I'm not real good at math without a calculator, but let me tell you, unless we're above 0%, I'm not making much money. So at some point, inflation will kick in. You will start to see rates rise. That's a given. The question is when, how much, how fast. I want to read you a quote that I pulled off the internet this morning from the Federal Open Market Committee. This is your government. Stick with me here. The committee continues to anticipate that it likely will be appropriate to maintain the current target range for a considerable time. As an investor, does that give you confidence? It's likely for a considerable time. Cool. That's definitive, isn't it? So I guess things aren't going to change for a while. So with the federal government telling you that it's not likely that things are going to stay where they are for a considerable time, do you have a great deal of confidence in that? Probably not. Now, ATKG didn't commission me, but I did create this just for you guys specially, and I'll sign this after we're done. But this is my interpretation of where we are in the market. We've got the market basket being carried away by the inflationary balloon, and essentially you've got these government controls holding it back. It's almost as if the market today is at an artificial low point. So at some point, that balloon will take off. The question again, when, how much is inflation going to cost us, and how fast will it kick in? I had the privilege last week of being able to sit through monetary policy and its impact on agriculture and farmland. This talk was given by a doctorate of economics from Purdue, the monetary policy and its impact on ag and farmland. I'm going to save you about 3 hours of napping and give you his 3 high points here. But his guess is in 2015, we're going to start to see things change. The first monetary policies kick in from the Federal Open Market Committee, leading to a little bit of a bump. 2016, Now we're rocking and rolling. Inflation's really starting to pump up. That federal fund rate will exceed 1%, bring us into 2017. So in 2017, if you plan on borrowing funds, you better get it done. You've got about 2.5 years left. Now, of course, this could all change tomorrow based on who throws a Coke bottle at a policeman in Greece, but that's the way it stands today. What's that mean for us here locally? Well, it probably won't be as bad. This will be more of a speed bump. You know, in Texas, we've got a tremendous unemployment rate. We're just about leading the nation. The energy sector's kicking off our economy. Things are looking strong. We're robust. We're having appreciating land prices. You can't be in a better spot necessarily to ride this out. So if the U.S. can outpace its predicted growth, if we can actually have some positive growth in the economy, and if you manage your balance sheet, if you don't tap into those long-term assets, pull your equity out and convert it into cash, chances are you'll be able to ride out that inflationary period and not come out too bruised. In our lending environment, you know, we're anticipating that. We're seeing continued competition. That's not going to go away. Again, those short-term rates at 0% have to move out into the market. So lenders are very, very competitive in that short-term environment. We expect your rates today to be stable for a while, but at some point it will start to bump up. So how do you get out of this thing? Well, if you're an aggressive borrower, you know, you like that short-term variable rate. 0% at your bank means a very low interest rate to you guys. That's awesome if you're aggressive, but chances are at some point that's going to come back and bite you. And I want to point out here, you know, writing out that variable, we've done some studies recently, and if you had a 10 or a 15-year hold on your money and you had a variable rate, you're going to go through the pains of a high interest rate followed by low interest rate, and you're going to ride that debt service change out. But over a 10-year period of time, chances are you came out better than somebody that went ahead and fixed for 10 years at that same beginning point. But it does come with a little bit of pain. If you're going to chase a fixed rate, if you're going to ride that variable out for the next year or two before you convert or refinance to a long-term fixed product, just beware. Because whenever your variable's going up, so are your long-term fixed rates. Just as a little bit of a side note, back in May of 2007, whenever the recession really started to kind of kick in and the Fed dropped their federal fund rate, that LIBOR rate was sitting at 8.83% versus a 3.49%. That's kind of our par rate today. That's about an average credit, but 883 versus 349, that's a big change. If you're a more conservative borrower, the more of the clientele that we try and coach through, now's probably the chance to really look at that historically low interest rate environment and grab a hold of something a little bit longer term, a 7-year product, a nice attractive 10-year product, something that will hedge your bets against that inflation. Yeah, you are risking a little bit as far as your interest rate cost versus a variable, but look what happened in that same time period. In May 2007, your fixed rate was lower than a variable rate. So just a little heads up there. Of course, if you're going to borrow money, I'm here to peddle our goods, so I suggest Capital Farm Credit. We are the largest co-op in the state. We've got about $5.5 billion in assets. We've got a customer base of around 18,000, 172 counties that we cover in the state of Texas, and we can follow you to Colorado, New Mexico, wherever your heart leads you. We are cooperatively owned, and that's our major win versus some of our commercial banks. With that co-op, you get a stake in the association. You become an owner. Just like any business venture, you get to participate in our profits, and we've been doing pretty good for the last decade. I want to show you just a real quick loan example using that same 7-year fixed scenario on a 20-year amortization. That's no balloon for you commercial bankers out there. Interest rate of 5.55, your stated face rate. Your monthly payments around $3,400 a month. In 2014, this last April, we would have sent you a check with your name on it for $7,500. You factor that into your debt service, and now you're borrowing money at almost 4%. In addition to that, we would have set aside another $9,100 for retirement at a later date, about 7 years down the road. That's another 1.86%, 186 basis points additional buy down that we're giving you. So at the end of the day, it really is a hard deal to beat, and we'd love to visit with you. And I know we've got some borrowers and some clients in the room, and I'd love to hear your success story.
That's the end of our program. So that's all of our presenters. Thank you so much for the time that you guys dedicated to putting this together and coming out and speaking today. We really appreciate it.